reasons to expect that. And now with the quiet period, we can start looking at the data. I think we're going to see data coming in weaker. Oil's down every day. We're going to have easy comps. I think the whole inflation fear is way overdone and it's starting to leak into the data. And with the Fed being quiet, we can respond to that.
So you think that the Fed is going to respond to what's going on with the yen, with the yuan over in China, with what's going on in the United Kingdom, and try to address the dollar strength?
I think some of that will come from the Treasury Department because that's really their responsibility. It's going to be subtle. It's not going to be, overt because we just can't do that. But I think they're going to start saying, hey, we already said we were going to do a lot, and this isn't a pivot. We got to our plan. It's getting time to watch and wait, right? We have done so much. We followed what we said we're going to do. So don't consider this a pivot. This is just part of our original program was to stop at some point and see how it plays out. So I think that's the messaging we're going to start seeing as soon as the Fed's allowed to talk again.
So do you think that right now, going back to your other point about cutting around the edges, basically cutting ad service, cutting other issues that you don't, that's not necessarily the core of the personnel of a company, do you think that perhaps the big tech earnings are not as well of a bellwether type of signal for the rest of the economy as some people are making out?
Yeah, I think that's probably true, right? They're adjusting to this specific shift, right? So there's other areas of the economy that are doing well. I think you can see autos, you can see places do reasonably well. So I think this is a unique factor. It's part of this pullback. If the Fed keeps pushing on companies and then they start having to lay off, I think this follows through even worse for tech, and that gets us to the hard landing. But for now, I think we can make it through this and start bouncing back up. Because again, a lot of these companies are down anywhere from 30 to 50% year to date. So even with these weaker earnings, there's still some upside.
Okay, this is the really frustrating part about this market. And I was struggling with this with Mike Wilson, and I could tell that he was too. And I'm curious from your perspective, how do you communicate to people? Short term, technical rally, but don't worry, I'm not actually optimistic about anything, and we're going to crash later on. How do you understand the pivot point in markets about when bad news becomes bad news? We start to understand some sort of hard landing that is divorced from the Fed's response mechanism.
That's a great question. For myself personally, I was trying to think in terms of, the next 20 bips on the 10-year treasury or the next 5% on equities. And unfortunately, now that means I'm a day trader almost because it moves so quickly. So I'm trying to avoid that and really make sure that I'm explaining to my customers, okay, this is short-term tactical, this is medium-term markets, and this is what you have to be doing for your firms or your companies longer term, like exiting China, et cetera. And it's a big struggle, I think, to figure this out. And you have to have conviction. You have to be small. And I think that's, again, one reason everyone's pulled back on position. So if we get any sort of rally, I think that can feed on itself a little bit easier than a sell-off can right now.
Yeah, especially because hedge funds have really pulled back on leverage, and you've had people really retrench with that bearish positioning that we've been talking about for quite a while. Peter, when you talk about the hard landing going forward, it's always interesting for me to hear people's worldviews and whether we're in a structurally higher inflationary regime, or as you say, you think that the inflation story is overblown. How do we get back then to a low inflation 2% type level, especially because you're telling companies to get out of China and stop doing business there because of some of the geopolitical concerns that the generals that work for your company talk about all the time?
So I think we have to take a step back and think about the starting conditions. Where did this inflation start? It happened because people were buying two of everything, right? People were so worried about their supply chain issues, they went and bought two things. Then you looked at companies themselves, they were ordering more in their supply chains. You had all these supply chain issues. The supply chain issues are dissipating. The consumers overspent. They're slowing down. I look at autos, for example, right? You go back a year ago, every email you were getting was someone looking for your used car. Then it was like, oh, buy this used car, get a new one. Now there's new cars again. This thing has shifted rapidly. Prices are declining. People are responding to the wrong metrics of inflation, right? The Fed kept talking transitory, transitory, transitory. They got it wrong to some degree, but some of these things are going away. And look right now, all the fears for Europe, energy prices are coming down there. Oil, despite OPEC plus cuts, coming back down. There is a real problem in the economy, and that's what slows us down. And that's why, yes, I'm so bearish about a hard landing. I think we've already done too much, and we've set a chain reaction in motion that is going to lead us to real problems later this winter.
So you don't think that there's a wage price spiral in any capacity?
I don't. I think you see some great headline numbers about the wages. I think companies have still been reluctant to hire. But your last guest, I think, made a great point. So tech companies are letting go, but tech is such demand that they can find jobs. But I think as these services cuts start coming through, if that's what we're really seeing, the next step is cutting your employees. And that, to me, is a real risk. If we can't get through some of the inventory hangovers and things that we have, people are just thinking about the wrong problems. They're all worried about the situation we were facing last year. and it's a very different. And if we step back, that idea of starting conditions matter. Supply chain's gone, consumer overspending's done. It's shifted heavily towards services overspending, but I think even that starts to go away. So January could be a little bit bleak.
Just real quick here, Peter, do you see 0% Fed funds rates in the next 5 years?
Ooh, I don't think I see that. I think they're going to be very reluctant to ever pull back. I think they've also realized that QE is really a nuclear option, and we treated it like a pea shooter. So somehow we have to extricate ourselves from QE, and we'll be reluctant to use that. So I don't think we ever go back to this easy money, because behind the scenes, they probably will admit that it does blow bubbles, but we will see easier policy over time.
Peter Scheer of Academy Securities, thank you so much. And coming up, we're going to be speaking with Sam Zell, founder and chairman of Equity Group Investments, that is on Balance of Power, with David Westin. Right now in markets, you are seeing a bit of softness after disappointments in big tech. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leanie Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Westin.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Live from New York City this morning. Good morning, good morning. 3 big days of gains on the S&P 500, colliding with some negative news and sending equities lower, much lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Here comes the pain.
We're starting to see it.
Street has been bracing for some breakdown, for cracks to begin to show.
This dollar strength feeding through.
We're seeing margins that are beginning to come under pressure.
We do have higher input costs.
We're starting to see credit metrics largely peak.
We do have the geopolitical tension.
Investors are just feeling pain.
Corporate cash balances have fallen over the course of the year.
There's an argument you're starting to price in a mild recession.
Clearly the concern that we and everybody else is having is the Fed going to go too far?
We're starting to see some of those cracks come through.
We're starting to feel it.
Let's have that conversation right now with TD's Priya Misra. Troy Gayeski of FS Investments joins us too. We're starting to feel it, Priya. We saw it in the house price growth data yesterday in the United States. We saw it in the earnings after the close. How bad is this going to get?
I think pretty bad. And it's because the Fed really does not have the policy space to respond. So, I mean, I think we're just starting to see the cracks. Real rates extremely high. And you've got a Fed that's, they may be downshifting, and I think that's a communication challenge. They may downshift in terms of pace of hikes, but they're going to keep going. And so, and you've already had, QT, I think, putting upward pressure on real rates. So tighter financial conditions in an environment where the consumer has largely run through accumulated savings, I think is making up for a slowdown in consumer spending. A Fed that says, look, we told you it was going to be painful. And so, we're actually looking for a pretty deep recession starting at the end of next year, continuing into 24. And the Fed only can respond once inflation gets closer to that 2% level.
And
so
the
I think
bond market
we're
is starting to rally in response to some of that, Priya. And I just wonder, with that in mind, how comfortable are you being long the long bond, going into everything you described?
So I think, I think the bond market's starting to wake up to it. I still think a recession is not priced into the bond market. We're pricing in 120 basis points of cuts in 2024 from a 5% terminal rate. I mean, that's still very restrictive policy being priced in. I think I like owning treasuries. I think the question is, do you own the front end because the Fed's going to respond, or do you own the long end because they're not going to respond? And I think inflation is still too high, too sticky. The Fed's worried about their inflation credibility. So I actually like owning the long end. I'm a little nervous about Bank of Japan here, but I think, if we can put, yield curve control changes a little bit in the back burner, I think owning the long end, that's really where that recession risk is going to get priced in.
On that recession risk, we caught up with Mohammed Al-Arian. Take a listen to what he had to say.
The risk of a U.S. recession is uncomfortably high. I don't like it where it is. I don't think it's a done deal. I don't think it's 100%. The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck because it no longer has time.
Troy, Mohammed says it's not 100% guaranteed. Priya's looking for it. What's a hard landing and what does it mean to you?
Yeah, so nothing's 100% in financial markets or the economy, but it's almost a certainty at this point. I mean, we've been stuck in this ugly environment all year where inflation's been simmering, obviously tighter financial conditions, and the probability of the Fed threading the needle now and guiding us to a soft landing is pretty close to zero. So, ultimately, what we're going through now is still more multiple compression, more financial condition tightening, driven not only by the front-end action of the Fed, but also the historic pace of balance sheet shrinkage, which has already caused agency RMBS spreads to go to the widest in history other than the global financial crisis. So that's going to trickle through markets. Obviously, you'll see wider spreads in credit. You'll see lower prices for equities. We're in the middle of a bear market rally right now. And then the next stop as we get into the recession is earnings obviously will decline. And that's been one of the bizarre things, John, about these bear market rallies is equity investors rooting for a Fed pivot driven by a recession.
Yeah.
And recessions are not good for earnings, right? Yeah. At that point, there'll be no more multiple compression, but clearly you'll have downside risk to earnings and you'll have a lower low being made in broader markets.
Troy, I'm with you. It's kind of bizarre. Of course, the first thing you trade on is the idea that they pause, they step down in rate hikes. I get all of that. But Priya, the second thing you trade on is working out why they're pausing, why they're slowing down rate hikes. And I don't see the beautiful, wonderful, positive supply side solution here. I see demand destruction on the horizon. And if Mohammed's right, if they back off because of financial instability, Priya, that's not exactly bullish either, is it?
Right, it's not bullish for the economy, and I think it's going to continue. I think they really want to tighten financial conditions, and the issue is there are going to be big lags. I think we'll all be looking at data. We'll find some high frequency measures slowing down, but for the labor market to really tighten, and I'm a little concerned that the Fed is looking for a small rise in the unemployment rate. It might just take a while. Things could be a lot worse by the time the unemployment rate rises because we're entering a slowdown with historic tight labor market, conditions. I don't think people are waiting on the sidelines to re-enter the labor market. I think that's a structural post-COVID shift. So by the time, if the Fed's waiting for 5% unemployment rate, things could be a lot worse because I think companies will be a little reluctant to lay off people, right away because it's been hard to hire or retain people. And I think that's why looking at that one data point and inflation, both highly lagging indicators, is almost guaranteeing that the Fed's going to be late. And this idea that they can preemptively pause or preemptively ease, I think we have to put that behind us. QE is going to be not used anytime soon. I don't even think they're going to take rates down to zero. So I think it's going to be a muted, monetary policy response. I don't think you get much on the fiscal front too. So I think that financial condition tightening is going to continue and it's going to get much worse. And ultimately that does impact the economy.
Priya, Troy talked about a bear market rally. And initially I wondered whether he was talking about equities or bonds. And I know now he's talking about the stock market, but we can talk about the bond market too. A rally yesterday, yields lower. Rally today, yields lower by 5 basis points, still north of 4%. Priya, in your notes, and you've said this to me today and before as well, you talk about that 4% level, and that 4% level ultimately being a buy. Anything above 4% on 10s. What is it about that 4% level?
So there's nothing psychological about 4. There's no technical level at 4 that there's massive support. What I look at is real rates. And really, if we got to 4% because inflation expectations are rising, global growth conditions, etc., and real rates were low, maybe 4 is not that magic number. The thing is, real rates, 10-year real rates at 1.5 or higher, I think is extremely restrictive to the economy. So that's how my 4% level or something around there, I think is attractive once the market starts to get more convinced that growth is slowing. So far, we've only seen it in a few data points. I think duration has been shunned by investors because you're getting, decent return in the front end. And, people, I think, concerned about QT, et cetera, pushing longer term rates higher. But once I think you start to get more convinced that the economy is slowing, duration risk, I think, is more attractive than credit risk or convexity risk. And that's when I think people start moving out the curve. But it's really real rates that I'm watching. I don't think that the economy can handle 1.5% 10-year real rates. And you could see it in the mortgage market. I think we see it in credit destruction going forward. And ultimately, that's going to slow things down. So that's how I get to that 4%. But, anywhere 3.5 or higher, if real rates are here, I think is a buy.
Started to see some weakness in the earnings yesterday evening as well. Equity futures right now down 0.9% on the S&P 500. Disappointing results from Alphabet. Ad spend, disappointing guidance from Microsoft. Katie Lyons has the story. Hey, Kaylee.
Yeah, John, if you want to see growth slowing, you can look at growth and revenue growth in the technology sector. Both Microsoft and Alphabet down more than 6% in pre-market trading after they disappointed. Texas Instruments also giving a disappointing forecast because of a deterioration in the chip space. And Seagate, a computer hardware company, down nearly 9%. It missed on the top and bottom line and announced it's cutting its workforce by about 3,000 employees, or roughly 8%. There is a theme here, John, and that theme is inflation is biting. It is eating into the demand side because customers are being more careful about what they spend, and therefore these technology companies that are also facing higher costs are having to make some very difficult decisions when they are lacking the ability to pass those input costs on. That definitely showed up in Microsoft numbers. Slowest sales growth in 5 years, but as you said, it was about the forecast, specifically the Azure cloud forecast showing corporate demand slowing in the cloud business. They also were struggling in the advertising sector, which is what Google is facing. We know that there is a slowdown in advertising because as you have higher inflation, companies are being more careful about their marketing spending. And that isn't just hitting the smaller companies in social media, it is hitting the giant. Both Google and YouTube revenue coming in short of expectations. And of course, if it's not a pretty picture for names like Alphabet and Microsoft, it's not a pretty picture for the broader market, because just those two companies make up 9.4% of the S&P 500 and nearly 18% of the NASDAQ 100. And today, it's not just they that are lower. They are taking other heavyweights like Meta, which will be reporting after the bell today, and Apple and Amazon, which are due tomorrow, down with them. Altogether, John, if the losses we're seeing in pre-market hold, we could see $300 billion worth of market value wiped off of big tech today.
Brutal yesterday evening and this morning. Katie, thank you. Alphabet, Google, down by 6.5% of the pre-market going into the opening bell. Troy, just how broad is some of the corporate weakness out there at the moment?
Yeah, well, clearly in large cap tech, I mean, they were the biggest revenue drivers for years and the biggest driver of profit growth. And, that's going the other way and the other way fast, right, as the consumer steps back and corporate spend step back. I mean, the early part of this year, CapEx is really strong. That's rolled over dramatically because the forward demand outlook is really poor, as you know. And then, of course, when financial conditions tighten this much, the incentive to invest and the ability to invest declines dramatically. So, when you look across equities broadly, it's unlikely that we have earnings declines clearly this quarter. The risk is there next quarter, but really next year is where you're going to see not only declines in earnings in large cap tech, but also, broader service facing industries as the consumer pulls back. Because as we were mentioning before, I mean, the U.S. consumer has single-handedly kept the global economy and the U.S. economy afloat. And as the labor markets only moved from white hot to hot and did transitions to cool, the consumption will contract. And then we're talking about that 2, maybe 3% peak to trough GDP contraction in real. The only hope for equities is that nominal GDP stays positive because inflation's still relatively hot, and there isn't as much margin compression as we think there'll be. But that is like a right tail of a right tail of a right tail outcome that looks highly unlikely.
Troy, Priya mentioned credit risk. You mentioned duration risk. You focus on differentiated risk. Where on earth do you find that right now?
Well, I'll tell you, so our favorite new expression in our multi-strategy fund is a trade that was very profitable from 2009 to 12, and that was taking advantage of interest-only cash flows, which are unlike any other fixed income instrument because they have negative duration, because higher yields lead to slower refinance activity. And so right now you can buy those, take advantage of a slowdown and a decline in the housing market, because as the housing market declines, all things being equal, it's harder to refinance because you need to eject equity in your home, and very few people will do that when an asset's declining and financial conditions are tightening and they're risking losing their job. So that acts as a slowdown mechanism for prepayments. And then, 3-6 months ago, you would have hedged that negative duration instrument with treasuries because agency pass-through spreads were still relatively tight. Now, given how much pass-through spreads have blown out, given the Fed's reversal of QE into QT, that's the way to pick up extra yield. So, we're modeling that out at like a 10 to 12% income stream. And we know there's other ways to generate an income stream like that, but this is non-correlated to broader markets. And just as important, it's negatively correlated to typically the most important asset that most individuals own, which is their home. So it's a very unique trade setup. We're not saying it's going to be nearly as profitable as 2009 to 2012, but we really like that risk-adjusted return right now, and the fact that, we don't have to speculate on whether the 10 years peaked or not. We don't have to speculate on, do equities bottom at 2,900 or 3,300? This is a nice cash flow stream that has low volatility and is very non-correlated.
Hey, Troy, I knew you wanted to fit something complex like that into the conversation. So that was your
Hey,
gimmick.
with you, you can handle it, right?
I tried to keep up at least. Anyway, Troy, you're going to stick with us alongside Priya. Thank you. We've talked a lot about the lack of a counter-cyclical circuit breaker in this moment in this economy because of the limited fiscal space that policymakers have right now. The monetary policy story is just to attack inflation, and they're struggling to support growth. Well, of that limited fiscal space, the Italians, the Prime Minister, mulling a new aid package worth up to 10 billion euros. That story just crossed on the Bloomberg right now. Coming up, Chet Powell's message from Jackson Hole, haunting lawmakers.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
The pushback, up next.
Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
The Fed's aggressive push fanning the flames in D.C. First came Senator Warren.
Do you know what's worse than high prices and a strong economy? It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip this economy into recession.
And then came Senator Bernie Sanders.
I think they're hurting the situation. I think that it is wrong to be saying that the way we're going to deal with inflation is by lowering wages and increasing unemployment. This inflation thing is a real issue. It is a global issue. But at a time when working families are struggling and the people on top are doing phenomenally well, I don't think you go after working people.
And now, with just 1 week until the FOMC meeting and 2 weeks until the midterm, Senator Sherrod Brown with his own message for Chairman Powell, writing in a letter, "We must avoid having our short-term advances and strong labour market overwhelmed by the consequences of aggressive monetary actions to decrease inflation, especially when the Fed's actions do not address its main drivers. Don't forget your responsibility to promote maximum employment." AMH joins us now in DC. Anne-Marie, the pressure builds.
Yeah, the pressure is building across some, we should say, that hasn't been a total Democratic Party joining this course and using the Fed as a scapegoat. But there is this pressure building, especially when you hear it from the head of the Senate Finance Committee, Sherrod Brown, just 2 weeks from the midterm elections, sending this letter to Jay Powell, talking about the fact that you have to focus on the dual mandate as well. And potentially this medicine to cure inflation may mean that there could be these gains that they've seen in the unemployment market get much worse, and they really would eclipse that. And this is the concern, Jonathan, you are seeing amongst Democratic lawmakers. Right now, of course, the Democrats are in charge of the House, the Senate, and the executive branch. And while Mohamed El-Erian told you just yesterday that it's not a done deal, there could be a recession, there is this potential slim chance the Fed could avoid it. The fact of the matter is Bloomberg Economics, our own projections, say that effectively there will be a recession in the next 12 months, and that is a huge blow for the Democratic Party and this White House.
AMH, this pushback is coming from senators. It's slowly building. How is the White House managing this message?
Well, the White House has been very clear when inflation was hit that first 40-year high, and this was a massive concern. They were trying to get gasoline prices down and communicate and message around higher consumer costs, whether it's grocery bills or rent, that it was the Fed's responsibility to tame inflation. But of course, the one thing this White House loves to pivot to is the fact that we are at a 3.5% unemployment rate, and there is a very robust, strong labor market. If the Fed is going too aggressive and you are starting to see a weakness in the labor market and you still have high inflation, it's going to be very challenging for this administration to talk about economic gains.
AMH down in DC. Anne-Marie, thank you. As always, Priya Misra, first to you. Just how political is this tightening cycle becoming down in Washington?
So I think we're going to hear more of this all through next year. I think, heading into the 24 election, I think we'll see the political tension. Do I think the Fed is political? No. I think they're trying to do the right thing. Inflation is much too high, and that unemployment rate, they have a dual mandate, and the unemployment rate is still well below what their estimate of NAIRU is. And actually, Chair Powell has said that NAIRU might be higher than 4%. So I think until the labor market weakens significantly, I think they're going to continue hiking. I do think they can stop talking about front loading. We don't know what the threshold is. At what point do they stop front loading? At Jackson Hole, Chair Powell said basically that they'll continue front loading, but you front load with 75 basis point hikes. We just have to look at the UK. The speed of the move is an issue. So at what point do they downshift, but still talk about continuing to move, Fed funds rate higher, looking at inflation, keeping rates there for a while? I think there's a little bit of that moderation. The threshold to moderate is not that high. The threshold to cut, I think, is very high. The threshold to pause, pause the hiking cycle, I think that requires a 0.2 month-over-month inflation for a few months. So I think we all have to grapple with these different thresholds. I do think there's a moderation coming, not because of political issues, but they've front-loaded a lot. Fed funds rate is going to be at 4% at the next meeting. If they go 75, they can moderate, go 50s. And then just stay there. But I think all through next year, we'll see the economy slowing. We'll see the political talk around why doesn't the Fed cut? And I think they're going to point to still high inflation readings. So I think that tension will just stay with us for a while.
The politics hasn't come out of nowhere.
Order
Troy, we
submitted.
talked about that speech, that address
Order
from
filled.
Chair Powell in Jackson Hole, Wyoming, for a reason. He talked about the pain they would have to cause. He also said that if we don't deal with it, it will mean even greater pain down the road, it being inflation. And Troy, the question we all asked at the time is, how does this Fed convince this country that higher unemployment is a price worth paying to get inflation down? Troy, have they done a good job of that?
Well, look, I think clearly they were way behind the curve, and we all joked around about inflation being transitory, although I don't think anyone forecasts 7 north of 8% CPI prints, just for the record. But the reality of the situation is that inflation causes much more political pain than unemployment going up. And that was a lesson that both politicians and the Fed lost or forgot, because it had been so long since we went through that period. So whether you're a retiree, a service member of the armed forces, a teenager trying to fill their gas tank, these high inflation numbers are very painful, and unemployment is painful for a smaller subset of the labor market. And so I do think their messaging has been much more on point recently that, look, the bottom line is we have to constrain inflation. If we let it simmer and become even more entrenched in services and labor, then we're going to have to use even tougher medicine. So it's better to front load, get the pain out of the way. And look, Chairman Powell has a very tough job. He's trying to balance a lot of different competing objectives right now. But ultimately, we are fairly certain they're going to do what it takes to break inflation. But of course, the price for that is extremely large, in that the next stop is a recession, where you will see a material increase in unemployment. So they have been messaging that much better now, when they moved away from the fantasy island transitory idea.
Yeah, and focusing now on pain. And Troy, you're right. How much pain? Troy Gayeski, Priya Misra, to the both of you, thank you as always. Going into the opening bell, equity futures are down by 8 or 0.9%. Up next, the morning calls, and later, big tech results derailing the rally. BlackRock's Jim Keenan saying the volatility ain't over yet. That conversation coming up.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading into space will really change our society over the next 50 to 200 years. It'll be completely different.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
A little bit of risk aversion out there right now. 5 minutes away from the opening bell. Futures lower, down by 0.9% on the S&P, down by almost 2 on the Nasdaq 100. That's the price action. Here are your morning calls. First up, BofA downgrading Whirlpool to underperform, noting that recent channel checks point to a slowdown in demand. Oppenheimer cutting its Microsoft price target to a street low, expecting FX headwinds to continue after reporting results. And finally, Raymond James cutting its Alphabet price target to 120, expecting the challenging macro backdrop to keep a lid on near-term revenue growth. That stock is down in the pre-market by 7%. Coming up, disappointing tech results threatening to erase $300 billion in market value. The opening bell up next.
Target filled.
A lot of the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Order filled.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Target filled.
That's a question I get all night.
Bloomberg, top experts, great questions.
We are coming off the back of 3 big days of gains on the S&P 500. Over those 3 days, up more than 5%. Today, we collide with some negative data, negative earnings after the close yesterday. Equity futures down by 0.8% on the S&P. On the Nasdaq, tech heavy, tech dominated. That's where the disappointment was. The Nasdaq down by 2 full percentage points going into the bout. That was your opening bout. Switch at the board and get to the bond market. Yields look a little something like this, down by 5 or 6 basis points. Your 10-year, 4.0463%. Are those risk mitigation characteristics starting to return to the bond market? Perhaps Priya Misra talked about anything above 4 being potentially a buy in this Treasury market right now. Off the back of lower yields, we've got a weaker dollar through the whole of G10 right now. The euro positive, stronger, back with a 1 handle on euro dollar. Back above parity, euro dollar positive 0.4%, and a rally in crude. Crude right now up by 1 full percentage point, $86 and around about 10 cents. 30 seconds into this session, one stock to look at, it's Microsoft. It's down by 7.8%. Disappointing tech results, and this was the message from the C-suite over at Microsoft overnight. Our outlook has many of the trends we saw at the end of Q1 continue into Q2. Materially weaker PC demand from September will continue as the stronger US dollar decreased total company revenue by 5 points. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. This was a couple of worrying earnings prints for the market, right? What was interesting in Microsoft's case is they actually beat on the top and bottom line in the quarter. But when you look at Azure, the cloud unit, and you take into account the impacts of foreign currency exchange, the growth narrative looks a little worrying. And then the killer blow on the earnings call was from Microsoft saying that going into this current period, there'll be a deceleration in growth to the tune of 5 percentage points. That really worried the market. The narrative around Microsoft is changing. Alphabet, the parent company of Google, also interesting. It missed on the top and the bottom line. And I spoke to the CFO, Ruth Porat, immediately after the numbers hit, and she said, look, the macro environment is challenging and it continues to look like it's going to be challenging. The dollar was also a headwind for Alphabet, but really, let's just be honest about what we're seeing. The resiliency in Google's core search business is not there. We see a weakening ad market globally, and we got signs from Alphabet that they have been hit by that. You look at where they missed expectations. YouTube in particular was wide of the mark, and what Ruth Porat told me was that they're seeing advertiser budgets being pulled back across the full spectrum of ad products in that line, both brand and direct response. So it's interesting going forward. You talked about how we've had momentum in these equity markets in recent days. We're snapping the NASDAQ 100's best streak in more than 6 weeks. You do wonder how this print actually changes the psychology of the market. We now have big questions about the global economy, but also the lingering impacts of that stronger dollar.
Well, Ed, talk to me about the ad spend. It wasn't just Google, Alphabet, it was Snap as well, and we've got Facebook a little bit later this evening.
We're painting a pretty worrying picture, right? When those Snap numbers hit, we asked the question, how transitory are these issues in the ad market? How specific are they to Snap? Then we got Alphabet, and we thought that actually the search business might hold up better. We thought that YouTube might hold up better. Remember, in YouTube's case, they're battling competition for eyeballs with TikTok. That's not what we're hearing from executives. This is pretty broad-based weakness. I pushed Porat to give me some granularity on geography, on the types of industries that are pulling back on their ad spend. Is this directly related to the consumer being hurt by inflation? They don't disclose those types of details, John, but she basically said this is a headwind.
Order filled.
And is going to continue to be a problem.
I can tell you where that move on Microsoft 3 minutes into the session, down by 7.5%.
Yeah.
Biggest one-day drop as we close here since March 2020. Now, bear in mind that move was close to 15% lower. They were tricky times, but this is bad stuff. And Ed, I would say let's talk about the breadth as well. The IT spend guidance that you get from Microsoft, negative. The ad spend guidance you get from Alphabet, not great. And then, Ed, it was Texas Instruments as well. Can you walk us through the significance of that particular print from that company yesterday?
Yeah, what you need to know about Texas Instruments is of all the makers of semiconductors, they make the broadest amount of stuff. Their chips go into absolutely everything. And when you look at the guidance, and especially their fourth quarter revenue guidance, which was pretty significantly below expectations, the takeaway is that the end market, consumer PCs, smartphones, the weakness in demand that we're seeing is now spreading beyond those categories into the other areas that Texas Instruments provides chips for. This is broad-based. Again, it's not just specific to the high-end smartphone market or the personal computer market, which were the earlier signs we've had in this earnings season.
Ed, awesome to catch up, buddy. Thank you. Let's just leave that board up right there 4 minutes into the session. The Nasdaq down by about 2 percentage points. That's the Nasdaq 100. The Microsoft story, that weighting in that index, it's a weighting of about 10% of the Nasdaq 100. That's just Microsoft alone. Microsoft down by 7.6%. Alphabet is down by 8 percentage points. And it's the breadth of this story. Ed and I just talked about it. It's ad spend at Alphabet. It's IT budgets, corporate IT budgets, showing up a little bit more negatively in the guidance of companies like Microsoft. And it's the breadth of the story, the industrial story for machinery beyond just computers and iPhones at Texas Instruments. That stock is down by about 5.8%. The broader market right now, about 5 minutes into the session on the S&P, we're down by close to 0.6% on the S&P. You can see where the pain is if you just break it down from sector to sector. Communication services down by almost 4%. Information technology down
Target
by
filled.
2.3%. Got to talk about credit as well. Jim Keenan of BlackRock's going to join us in a second. Here's a quote from him. With consistently strong inflation prints and with economic and rate uncertainty, there's a greater downside risk to holding equities relative